Welcome to The Explainer. Today we're pulling on some threads that connect record high risk in the stock market to a massive underlying shift in global power and trade. It's a story about a financial system that is, well, right on the edge. Let's get into it.
We're going to start with what a lot of people are calling the single most dangerous signal in the markets right now. And it all comes down to an absolutely unprecedented level of leverage. Take a look at that number. Over $1 trillion. That's how much money is currently being borrowed by investors to pile into the stock market.
And just to be clear, this isn't just another market high. We have never, ever seen this much leverage in the system before. We're in completely uncharted territory.
It absolutely blows past the peaks we saw right before the last two major collapses. The dot-com bust and the 2008 financial crisis.
I mean, just look at the scale on this chart. The little bumps back there are the moments that blew up the system before. The current level it dwarfs them. It's a totally different animal. So you have to ask, who's on each side of this gigantic bet? Because what we're seeing is a massive and, frankly, a pretty scary divergence in behavior. On one side, you have the corporate insiders. We're talking Jeff Bezos, Jamie Dimon, Warren Buffett, Mark Zuckerberg. They are all selling stock, dumping it actually, to the tune of about $2 billion a week since June. And on the other side, well, that's the retail public, taking on all that record debt and holding their largest allocation to stocks ever. It just begs the question, right? When the so-called smart money is sprinting for the exits, while the general public is borrowing money to double down, well, you create an incredibly fragile situation.
Now, this idea of fragility, it's not just in the markets. We see the same pattern in the economic data, where there's this growing chasm between the headlines you read and the reality hiding underneath.
We all saw the news, right? Strong job growth. May and June looked great. Almost 300,000 jobs apparently created. The markets loved it, and the story was the economy is humming along.
But then the revisions came out, quietly. Weeks later. That robust 144,000 gain in May? Yeah, that was slashed to just 19,000. And June's impressive 147,000 revised down to a measly 14,000. So in total, more than 250,000 jobs just disappeared from the official data. It was one of the biggest revisions in history, and it completely changed the economic story, but only after everyone had stopped paying attention. And you can see why this kind of thing has caused some analysts to just lose all faith in the numbers. Some have gone so far as to call the official data from the Bureau of Labor Statistics nothing more than propaganda, designed to manage how we feel, not reflect what's really happening. So you have to wonder, if the traditional pillars of the economy are showing such deep cracks, what's the backup plan? Well, for the West, it looks like a full-speed pivot into a brand-new digital financial world. And that's not my interpretation. That's a direct quote from officials about their strategy. And the core of this whole plan, it revolves around something called stablecoins. Basically, cryptocurrencies that are pegged to government money, like the US dollar. So here's how it's designed to work. First, corporations all over the world issue these stablecoins. Then, by law, every single one of those coins has to be 100% backed by U.S. government debt. And what's the result? Boom, a projected $2 trillion in what they call synthetic demand for U.S. treasuries, at a time when traditional foreign buyers are backing away. But here's the really crucial point. What is this new system built on? It's not built on tangible stuff, not on production or savings. It's built on a self-referencing loop of digital tokens that are backed by debt, which are then used to fund more debt. It is, as some have called it, a digital house of cards.
Now, while the West is busy building this digital debt system, a completely different economic model is being put together, and fast, by the BRICS Plus nations and their partners. This is what some are calling the Great Divergence. On one side of the world, you have a financial future based on digital assets and synthetic demand. And on the other, you have a system being built from the ground up to trade physical things. We're talking oil, gas, metals, and food. And at the absolute heart of this new system is their mBridge platform. It completely bypasses the Western SWIFT network. It lets central banks trade directly with each other. And get this, it settles transactions in 7 seconds.
and it cuts fees by 98%. It already connects nations with a combined population of over 700 million people. This is happening now.
This major shift towards a system based on physical commodities, it's showing up in the markets in a huge way, specifically in the precious metals market, where we are seeing an unprecedented global rush for physical gold.
I mean, these numbers are just extraordinary. In only the first 3 days of the August delivery month, buyers on the COMEX exchange demanded physical delivery of almost $7 billion worth of gold. And this isn't a one-off thing. We're seeing these record-breaking deliveries month after month.
But here's the detail that really tells the story: a 1-to-1 settlement ratio. That means every single contract is being settled for the actual physical metal. People aren't just trading paper back and forth anymore. They are demanding the real thing. That is a very rare event, and it signals a massive loss of trust in paper promises.
Okay, so when you connect all these dots, the public is leveraged to the hilt, the insiders are selling, the official data is questionable, and two entirely different global systems are emerging. It brings us to a very stark choice, one that investor Rick Rule has framed perfectly.
His argument is incredibly blunt. If you hold your wealth in a currency that he believes is being intentionally and systematically devalued to deal with unpayable debts, you're playing a losing game. By definition, you're going to go broke in terms of purchasing power.
But on the flip side, he argues that if you measure the cost of real things, like a house or even your groceries, in a hard asset like gold over a long period of time, those things actually become much cheaper. Why? Because the gold holds its purchasing power while the currency just melts away. And that really leaves us with this final, provocative thought. In what truly feels like a historic turning point for the entire global financial system, with insiders and even whole countries moving against the crowd, maybe the biggest risk isn't being a contrarian. Maybe the biggest risk is becoming a victim because you weren't.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.